Thank you all for joining me on this webinar about Investing 101 for the Foreign Service community. My name is Warren Covert. I'm the founder and principal advisor at FSO Wealth. I'm a fiduciary, hold a FINRA Series 65 license, and a business degree from the Haarlem Business School in the Netherlands. That's also where my accent is from. I'm a dual citizen and an EFM. Quick disclaimer. Everything you'll hear here today is educational in nature. It's not personalized tax, legal, or investment advice. And this is what we're going to cover today. Let's talk about the TSP first. One of the most common misconceptions about the TSP is that people treat it as a savings account rather than an investment portfolio that it really is. Because no one ever sits down. And the TSP is actually two accounts. You have a traditional TSP and a Roth TSP. And by default, when you start your career, you contribute 5% of your paycheck to the traditional TSP. That's also where your match goes to, the traditional TSP. There's one limitation worth knowing is that you cannot run two different investment strategies among the traditional and the Roth TSP. They follow the same allocation, but despite that, it's still one of the best retirement accounts out there that I've seen. And it's not just for FSOs, members of Congress also have one, as well as civil servants, something about how powerful it is. Once you contribute to your TSP, you have access to 5 funds. But before picking any of these 5 funds, it helps to know a couple of things to give your investment some direction. You want to have an idea of what you'll need in retirement. And at a minimum, you want to know what's going to happen under your current setup, under your current investments and contribution rate. Once you know that, you start to see whether you're on track and you know whether adjustments will be called for. You also want to be aware of your timeline, how long until you retire and when you're going to need the money after you retire. These can be two different dates. And by default, that 5% that you contribute to your TSP goes to the L fund. The L fund is a combination of the 5 TSP funds. First two that we're going to discuss, the G fund, it holds securities. They're issued by the Department of the Treasury. This is the only fund that's guaranteed to pay you back your principal and your interest. That's because the Department of the Treasury defaulted on its payments. So it sounds very low risk, and it is in terms of market risk, but low risk isn't always the same as safe. And what I mean is that historically the G fund has had the lowest return out of the 5 TSP funds. So while it's nice to log into tsp.gov and see that all your money is there, if inflation is starting to outpace or starting to level up to the rate that you get in the G fund, that's slowly going to erode the value of the money that you have in there. The second fund is the F fund. This fund is also aimed at capital preservation and it holds debt securities. So it doesn't hold stocks, it holds bonds and those pay interest, just like in the G fund. But the investments of the F fund, they go towards corporate debt, and corporate debt is inherently seen as riskier than debt issued by the US government. The next 3 funds we're going to discuss are aimed at long-term growth. We'll have the C fund, the TSP favorite. It represents the S&P 500, so the 500 largest companies in the US. Think Apple, Amazon, Nvidia. You've heard of a lot of them. The S&P 500 is also seen as a benchmark for other types of investments. So if you underperform the S&P 500, people might say that you haven't done a great job. If you outperform it, people would say that you did fairly well. However, outperforming the market isn't as important as not running out of money in retirement. And we'll get to why and how later. But the C fund holds over $500 billion in assets. It holds about half of all TSP funds, and the TSP is worth as a plan, as an institution, over $1 trillion. There are over $1 trillion of retirement savings in the TSP. If you think about the US stock market as a whole, part of it is covered by the C fund. The part that's not covered by the C fund is covered by the S fund, the small and mid-cap companies. And although they're called small and mid-cap, they're still multi-million-dollar companies. But relative to the C fund, they're small. And historically, we've seen that these smaller companies have more room to grow. But when things go south, this fund also tends to crash harder and faster than the C fund. Means in the good times, the S fund has the possibility, the prospect to outperform the C fund, but it's gonna add a lot more volatility to your portfolio. So these funds together, C and S fund, are a good representation of the US stock market. A lot of FSOs I talk with, they ask me why there are only 5 funds, why do you not have access to more investments? And you have access to pretty much the whole US market and the whole international market. It's just sliced up slightly differently than in other plans, in other accounts. And if you do want access, if you do want to diversify to the international funds, you're going to allocate some toward the I fund. It holds over 5,000 stocks of non-US companies, non-China and non-Hong Kong. This fund has done really well last year, and I've spoken with many officers who took some of their portfolio and put some extra to the I fund because it is what everybody was talking about. I do want to remind people the growth that has already been realized is not necessarily going to happen again. Just because this fund did well last year doesn't mean it's going to do well next year. And by default, you're allocated into the L fund, which is a combination of the 5 funds we've just discussed. Assuming you have at least a 20-year career ahead of you, you're allocated in the L fund. Then on day one, that L fund is structured for long-term growth, so it holds mostly C, S, and I funds. Your L fund also has a number connected to it. So if your number is L45, that means that TSP estimates that you are going to retire around 2045, at which time the fund transforms into the L income fund. And it holds about 70% of its assets in G and F at that time. And the L fund has some major blind spots. It doesn't know what other income streams you're going to have in retirement. So it doesn't necessarily know how much income you actually need. It also doesn't know your expenses. It's more common now to see a TSP millionaire than it was 10 years ago because of market growth, higher salaries, high contribution limits. So let's say you retire with $1 million in your TSP. About 700,000 would be invested in the G and the F fund at retirement. So 700,000 in the capital preservation fund. So you might ask yourself, when I'm retired, why would I still be exposed to the market at all? Why would I still want to see those ups and downs in my portfolio? And the reason is this. So when you retire at 65, but many of you sooner, you still have about 30 to 50 years of retirement ahead of you. 5 decades of investing is long-term in my book. So investing part of your TSP for long-term growth in retirement makes a lot of sense when you take that into account. But if you flip the question around, if your retirement is possibly longer than your 20-year career, why would you invest $700,000 in conservative holdings instead of invested for long-term growth? Are you really going to need that $700,000 in the short term? Probably not. And that is because the TSP is not your only source of income at retirement. You'll have your foreign service pension. If you retire early, you get a pension supplement. Social Security is going to come on top of that. Many FSOs build a portfolio of rental houses. They have a rental income. At a minimum, you have 3 sources of income: your pension, your Social Security, and your TSP. Now, the good news about the life cycle fund and the TSP funds as a whole, and it's really good news, is that they're genuinely low cost. If you've worked in the private sector before and you've had a 401k, you've taken a look at the investment menu, you may have noticed expense ratios. And the TSP's expense ratios compared to any other retirement plan are genuinely low cost. The TSP has been offering those mutual fund windows, and those come with their own fees. So they're not as low cost as the other 5 funds. And if you are interested in expanding your investments, in adding some different ETFs or sectors or stocks to your retirement plan, I'll show you how to do that in a couple of slides without having to navigate the mutual fund windows. But one of the most important concepts in financial planning, in managing your TSP, is that planning comes before investing. Many investors focus heavily on the long-term growth without a clear goal. The financial plan really defines your priorities and timelines. For FSOs, the plan may include a large lump sum withdrawal upon retirement, so that when you retire from post, you get back to the US or wherever you want to retire. You may need to buy a vehicle. You may want to move back into a property that you've rented out that needs to be remodeled. You may want to buy a retirement home. These are all parts of a financial plan that the L fund won't take into account, but you can take into account yourself by setting up different savings goals. And when you map out all those goals and your timelines, it's going to become a lot easier to find the right funds so that you can move efficiently towards your goals. There's this old Wall Street story of 1891 that a trader, he was so anxious about his market position, so about the stocks that he was holding in his portfolio, that he couldn't sleep at night. So he asked his friend for advice. Apparently, this friend was JP Morgan. He asked Morgan, "What should I do?" To which he replied, "You should sell down to your sleeping point," meaning sell just enough so that you can actually sleep at night. And true or not, that story has guided investors for over 100 years now. If you hold too many funds for the long term without a clear purpose, you might get nervous about short-term market movements. So a good financial plan, an idea of where you want to go, can really help you navigate those moments. Well, let's see how the TSP and the funds held up in the market. The market is really two things. You're exposed to short-term fluctuations, and historically the market has seen long-term growth. And understanding the difference is key to sticking to your plan and working towards your goals. So from day to day, stock movements can really only be described as random. But if you zoom out over a longer time horizon, the markets have historically trended upward, driven by economic growth, innovation, and productivity gains. And when you invest in your TSP for your retirement, you're investing for the long term. So it's important to stay on track. Those short-term fluctuations can cause huge ups and downs, especially in recent years. So Warren Buffett probably said it best, that the market in the short term is a voting machine. And in the long term, it's a weighing machine. And what he meant was, in the short term, prices will go up and down, but they go up and down as a result of what people think the company is doing. In the long term, the value of the companies, the value of the economy as a whole, has gone up because of those productivity gains, because of millions of people going to work every day. If we look at the S&P 500 over the long term, we see tremendous growth. And before we get into what we're looking at, take a look at the y-axis here, because it looks like a straight shot up, but it goes from 10 to 100 to 1,000. That's because that growth is measured in points. Points go up exponentially. A 10% upswing in the 1920s would be 1 point. A 10% upswing today would be about 800 points. Same 10%, same dollar would be 110 after that 10% growth. So the S&P 500 is the benchmark for how investments and the market as a whole is doing. It's a good representation of how the C fund has done as well. But over the last few years, we've had quite a bit of scares. We've had COVID, here the yellow dot, the red dot, where trade policy announcements that shook up the markets. But during COVID, the markets bounced back within 3 months, even though it felt like the world was going to end, and we all saw our TSP values go down. Same here with the trade policy announcements. Don't think it took longer than a month for the market to recover. But a lot of folks, a lot of FSOs that I spoke with quickly moved out of the market and into safety of the G fund. And not everybody jumped back at the bottom. In fact, rarely is it the case that somebody jumps out of the market, buys back at the bottom. When people jump out of the market and they wait until it's safe again to get back in, typically wait until the gains have already happened. So responding to those short-term volatilities doesn't always work out in the way people hope it will. So let's do a little experiment here. We're looking back almost 100 years. Been through the Great Depression, 70s, which was the worst time to retire in the last 100 years, low growth, high inflation, but overall, tremendous growth. And if you had $100 in 1927 and you put it in the market, what do you think it would be worth today? So since 1927, the average growth rate, the average annual growth rate has been 12%. about 12%. And that $100 invested would be worth $1,157,010 in nominal terms today. It's not accounting for inflation. If growth and inflation had been equal during this whole time, that's $100 then would be $100 here. But that's also not what happened. The last 100 year, the inflation rate was about 3.26%. And if you adjust the growth of that $100 for inflation every year, that $100 would still be worth $61,734 today. So that should really tell you two things. The stock market is an incredible force to help you build wealth, and that inflation really eats away at your capital, at your retirement savings, and at your returns, even if that inflation rate is much lower than the returns you're getting in the market. So really be aware of what you are invested in. Low risk is not always the same as safe. And we have numerous examples of market downturns during this time. Here are the last three big ones. Each crash by new highs, by new recoveries. But this only mattered for investors who had three things in common. It worked out for people who had a long enough time horizon to stay invested. They actually stayed invested. They didn't sell at the bottom or on the way down. And they also didn't sell at a loss. They actually stayed invested long enough to profit. And without a good plan, without good guidance, it is hard to navigate these crashes, these up and these downturns. So staying invested, having a plan you can stick with, often gets you out ahead instead of responding to these short-term volatilities. That's one really big thing I do for the people I work with. I stress test their plans. So we see in advance what would happen if COVID was there tomorrow. If we are in 2007 today, tomorrow the market's going to crash, would you still be on track for retirement? So stress testing your plan, your investment strategy is important. If you don't know what's going to happen, if you don't know why the market is going down, how long it will be going down for, it can get kind of scary out there. Let's look through the market cycles of the S&P 500. So instead of a straight shot up, looking at cumulative returns, cumulative downswings. And I want to point out before we get into it, see here, the upswings can get really high, over 400%. However, the downswings seem fairly low. And that's because we can only go down 100% before there's nothing left. On the upswing, theoretically, there is not really a hard ceiling. But of course, the economy cannot grow forever. There's a society, there are people with savings accounts with needs that support that growth. We cannot support endless growth all the time. So the market goes up and down over the years. Let's talk about some facts to help you make more informed decisions in your TSP. Over the I'm going to say 100 years, it's 98, but 98 years to be exact, what we're looking at, about 73% of the time, we've had a positive year. So roughly 1 in 4 years, we've had a down year. That sounds really good. But if I were to go in for surgery, the hospital, and the chances were 1 in 4 that things wouldn't work out, I would get a second opinion. Same logic can apply for investing in the short term. Because if you invest for the long term, if you stay invested, the chances that you come out ahead are much higher than 1 in 4. The longer you stay invested, the better those odds are going to look. We know already that the average return over this period has been about 12%. But there were only 6 years where the return was somewhat close to 12%. Most years, we either go way up or way down or close to zero. But the S&P 500 never actually had a 0% return in a given year. The longest negative streak was 4 years, and the longest positive streak was 9 years. So if we look back, we analyze the history of the S&P 500, the history of the C fund, we start to see the odds have worked out in our favor. But of course, none of this is any guarantee for the future. It does show you how investments have behaved over a long stretch of time. The market has built massive wealth, and we have a lot of data like this available these days to help us make informed decisions. And this is how the other funds have stacked up against the C fund, against the S&P 500. Now let me tell you what we're looking at. We're going back to 2002 here, and that's because at that year the TSP looked like the TSP that you know today with the 5 funds. Taking the data from tsp.gov, put $10,000 in every fund in 2002. I've looked what would have happened to this $10,000 if I would just let it ride. So no additions, no withdrawals, no rebalancing. We'll see here that $10,000 in both the C and the S fund, in the American stock funds, would be worth $95,000. So throughout all those crashes, almost 10x the inlay. We also see in the orange line in the S fund that the S fund had a much wilder ride up than the C fund. Steeper declines, faster upswings, and right now they're roughly the same value. We don't know what's going to happen next year with those funds. If we compare this to the I fund that has done really well last year, we'll see that the $10,000 would be worth $50,000 today. So about half of the American stock funds. And it is seen as riskier as the C fund, according to TSP on their website. Risk and return should go hand in hand. We don't know what's going to happen if the trend will continue, if the I fund will continue to catch up. So the international fund does respond to the economy, to the international economy differently. Therefore can smooth out some of the overall volatility of your portfolio. So if you've invested everything in the I fund, and after 23 years you 5x your inlay, you might think you did really well until you see this chart and you see the opportunity cost, about $45,000 in difference by taking different decisions with your investments. And then there are the G and the F funds. And the $10,000 would be worth 20K in the G fund, a little more in the F funds. What they did do really well during that time, it held their value. If you logged on to tsp.gov, didn't see much losses happening if everything was in the G. However, the opportunity cost over the course of 23 years is remarkable. So while it did its job very well of keeping your portfolio steady, the opportunity cost is about $75,000. And that's a cost that won't get tracked in your TSP, in your portfolio. Something that quietly slips away until you start looking back and see how other funds have done. TSP is not the only place we invest in the foreign service. And if you start investing outside of your TSP, you don't only have to pick your own funds, and there are thousands of funds and stocks available, not just 5 that cover the whole bunch. And you have to pick the right account. What account are you going to use for which investment? Outline 3 types of accounts that FSOs typically encounter when they start looking further than TSP. Taxable brokerage accounts, perhaps best well known. It's an account you can open at any custodian. You can buy and sell any stock you like. But if you make a profit on a stock and you sell it, you'll be taxed on your gains. But a big benefit of these accounts is that you can access the accounts at any age. No age restrictions, no contribution limits, no income caps. Now, if you max out your TSP and you want to invest more towards your retirement, you might consider opening up an IRA, either traditional or Roth. These accounts come with restrictions in that you can only access them at 59.5. You can only withdraw from them when you're 6 months younger than 60. But these are really geared at retirement savings. Most of them have way more options than the TSP offers, but the restrictions are a little bit different, and they come with their own contribution limits on top of your TSP contribution limit. And the Roth IRA comes with income limits as well. At a certain point, you're phased out, especially if you're a tandem or late career. You may be near or over that threshold. One other time you may start thinking about opening an IRA is before you max out your TSP, but you want more access than just the 5 funds. And you don't want to go through opening up one of the mutual funds in the TSP. You can open your IRA and see what's available there. Thousands of ETFs, thousands of mutual funds, not restricted by the TSP. And if you have a family and someone in your family has educational goals, Most FSOs will come across 529 plans. Not everyone opens them because the information out there is pretty scattered at best. This is what I help my clients with a lot, helping them pick the right accounts and 529 plans, and which 529 plan is typically a big topic, especially for families or for FSOs who want to do some continuing education. And they are offered by the states, and they come with their own tax breaks depending on in which state you open them. They work sort of similar to the TSP in that there is a set menu of investments available for you, or in most cases a life cycle fund. But if you open any of these accounts, you're probably going to have more than 5 choices. To profit from an investment, you have to be right 3 times. You have to select the right investment, you have to buy and sell it at the right time, and it must be held in the right account. And to keep those profits, be sure to keep your commissions low. The TSP does that for you, essentially. If you're going to invest outside of your TSP, look up the expense ratio. In some cases, 0.25% might be good. In other cases, 0.5% might be competitive. It really depends on what you're investing in. So expense ratio is what you're looking for in these cases. If you're going to start picking funds, where do you start? There are 2 steps you can take. First, start with your goal, what we've talked about, same process for in your TSP, and check your risk tolerance. Not only how are you going to behave during market downturns, but also when do you need the money, especially when it's not for retirement. How long is your horizon? And that largely determines how much volatility you want to see in your account. The higher the future projected returns, the higher the volatility probably is. There are 3 principles you can take away with you today. Understand what you own. So if you can't explain what the fund invests in, you should probably not invest in it. You want to know why it's going up, why it's going down. Go slow. The longer you are in the market, the better your chances are at making a profit. If we look at history. And don't work with professionals you cannot understand. If you work with an advisor, with a CPA, with someone in insurance, they don't speak your language. They can't tell you what you really need to hear. And when you start opening up investment accounts outside of the TSP, you have the opportunity to invest in single stocks. It can be a very appealing activity. It's important to understand that even if you pick a winner, they're probably not going to lead the market for. And right now, there's a lot happening, especially with AI. We don't know which company is going to profit from it the most. Are it the companies that produce the large language models, or are it the companies that adopt AI in their processes in order to make their companies more efficient, deliver more value to their clients, lower their costs, and thereby grow more? Don't know what's going to happen next. But we are in very interesting times, lots of innovative changes happening. So what is the best allocation? What is the best investment in a portfolio? And that's different for everyone. The one thing that everyone has in common is that the best allocation is probably the one that you can stick with through a 50% market decline. Your portfolio is keeping you up at night. Might be something that you need to look at. So even though you pick a portfolio that has the highest projected returns on paper, 100% stocks, 100% growth. If you are going to abandon your strategy during a crash, you might have been better served with a portfolio of 10% stocks and 20% bonds. That's perhaps a lower average return. But if you can stick with the strategy, you may come out ahead. And one thing you can do to manage the risks, to navigate those bumpy rides, those bumpy times, is diversification. And the TSP does this in multiple ways. If you own one stock of the C fund, you own part of 500 different companies. So the fund in itself is already diversified. However, those 500 companies are probably going to react in similar ways to the economy when things go well and when things are not going so well. By holding an investment that invests in different companies, you're reducing the risk of bad returns of any single company in that fund. And then to diversify even more, you can add different funds. So you can add the D, the S, and the I fund. Things start to level out. You're not going to get the worst of times and not the best of times, but you can design a strategy, a portfolio that gets you to where you want to go, the investor behavior gap. And the studies have consistently pointed out when they researched the returns that any individual fund had and they compared it to the profits that the investors made, the investors in that fund, they found that over the course of a decade, investors had missed out on 15% of growth. Largest drivers for those missed returns is buying and selling and selling and buying at suboptimal times. We now know that the S&P 500 has returned about 12% on average. So missing out on 15% means missing out on over a year of gains. So really the most important thing to your results in your investment career is how you will behave during the worst 5% of the times. So we've covered a lot today. Told you about the 5 TSP funds, what they do, what they're for. Talked about how risk and safety aren't the same thing. Talked about market volatility and how diversification can help you stay the course. We talked about timing decisions and how suboptimal timing decisions reacting to the markets can explain a large part why some investors underperform. Before we jump into questions, and I've already received a couple questions during sign up, if you want to talk about your personal situation and you click here, you go to my calendar, same as when you scan this QR code. You can create a free account here in our financial planning software called Findash. It's a free account. You won't become a client just by signing up. You won't get how we work. You can make use of our secure vault. Thank you all for joining.